Hey everyone, I'm back again, this time virtually, to talk about buying a home in the Sacramento Valley. Our market here is as unique as you are, and it can take some serious fancy footwork to get into a home, but Alliant is here to help. At the end of this webinar, all the resources are going to be listed, so feel free to reach out directly at any time with any questions that you might have, and we're happy to help. Okay, so today I'll be going over all what is involved in buying a home, giving you the awareness beforehand of what the market's like, how it varies by county and area, how that might affect your buying power, and I'm going to talk about all the intricacies involved in buying a home here, from looking to bidding to the mortgage process and escrow, all the way to the very end when you're moving in. And as always, ping me with your questions. If I don't know the answer, I can certainly point you in the direction of someone who does. Also, I want to make sure to mention throughout this webinar, you're going to hear me refer to Alliant often. While I'd love to specifically call out other lenders and practices that they might have, things that differentiate us, I can't. I work for Alliant and I know their products through and through, which is why I can really only speak to Alliant services. And with that, let's move on. Cash and credit preparation. It's important to get your credit prepped about 6 months in advance of getting pre-approved for a home mortgage. Dispute any inaccuracies well in advance. Part of these inaccuracies could be seen in your birthday, your social security number, prior addresses, any loans or lines of credit that you may have out right now or have had within the last 7 to 10 years. 3, trade lines. This is a big one. Lenders like to see that you have 3 of any type of credit. So it could be a credit card, a loan, a car loan, a student loan, open and active within the last 12 to 24 months. These are really important trade lines that help establish your credit and your risk. Leave your older credit lines open. Even if you aren't using them, if they aren't costing you some kind of unreasonable amount every month in maintenance fees, leave them open. They enhance your score, they show your longevity, no reason to close them, especially within 6 months of trying to get a home. Biggest one ever, stop buying on credit. One of the biggest mistakes that I see quite often is that folks go out and they purchase furniture, they purchase appliances. Those large appliances drive up the balance on your credit cards, or they can deplete your savings account. And they do it before the loan closes. My recommendation, wait until after the loan closes before racking up any debt or spending any more on your savings. Keep 30% mantra in your mind 6 months before you apply for pre-approval. The 30% mantra is to never go above 30% of the total available balance on your credit card. So if your credit card balance is $1,000, don't spend more than $300. Cash prepping. Okay, so this is also really important. Don't shuffle money around. Leave it to season for at least 2 to 6 months, and every lender is going to be a little different. Alliant requires 60 days for the funds to be considered seasoned, but many lenders require much longer times for large deposits like that, especially for a down payment and when they're assessing your risk. If you can't show the funds have been seasoned, meaning that they've been sitting in your bank account for that period of time, it doesn't mean that you're going to be denied for the loan. It just means that you need to prove where the funds have come from. So for example, if you moved money from one savings account to another, if you took money out of your 401k to get your home, you just need to have that paper trail showing where the money came from. A lot of that has to do with gifting. So you'll see sometimes grandma, grandpa, rich uncle, mom and dad gives their child or their special person in their life a cash sum of money in order for them to go and purchase a home. That's fine, that's great, but you may need a letter for the lender to approve you, a letter to show that these folks who have given you the money have no intention on ever collecting that money back or requesting the money back. Having a lender like that proves that the funds will be yours and thereby negates any kind of seasoning that you would need. All right, last portion of the credit or the cash prep. So it's important for you to also know your loan preference or your options. And this is something that you can discuss with your mortgage consultant over the phone or in person whenever you meet with them. So it's important for you to know if you can afford to have 5, 10, or 20% down payment on your home. And perhaps you really aren't sure. You know that you have, for example, $100,000 in savings ready, but that doesn't necessarily translate into a 20% down payment on a $500,000 home. For example, on a $500,000 home, the average closing costs and fees anticipated are around $8,000. In other words, your $100,000 in savings might actually only translate into about 18% down payment, which automatically means PMI, and PMI is private mortgage insurance, with almost every lender in the country. PMI is about $175 a month for a loan of about $408,000, just keeping with that example of a $500,000 home, right? It's a nice round number. That additional cost on top of your mortgage payment might actually affect the amount that you can afford in getting a home. So make sure that, when you're getting ready to get pre-qualified for a mortgage, be frank with your real estate lender. Let them know what kind of cash you have available and if it's a concrete number or if there's some wiggle room. And just remember that even in the event that a family member wishes to gift you funds to cover any of those excess costs, you're most likely going to need a letter from that person, just showing that they are gifting you the cash, not the chance, to authenticate the gift is a gift and not ever expected to be repaid. We're all aware of the 401k that you have through Kaiser's benefit plans. But did you know that you can borrow from it to help with the down payment portion of buying a home? If you didn't know before, you know now. There are many details that go into this option, but just know that you can actually pull funds out from your 401k up to $50,000 actually, as long as you have the funds available to borrow. It's a great resource to have when you need to come up with a large sum for a down payment. I encourage you to review all the terms and conditions Vanguard has regarding these types of loans or withdrawals on their website, which is actually available to you through your Kaiser intranet. And if you have other specific questions, I would also encourage you to contact your local Kaiser benefit consultant. This is their position and they can help you with getting any additional resources or answering any additional questions that you might have. When you're ready to put in an offer on a home, it's important that you have your pre-approval letter. In fact, most realtors representing you will ask you up front if you've already completed this process. Because of the way the market's here in California, especially in the northern part of the state, homes don't last long, and you need to have a strong offer to compete to just get a home. Strong offers mean that you have already kind of started the mortgage process and you've gotten pre-approved, you've gotten a lot of your paperwork together. So here we have the items that are generally the bare minimum needed in order to get pre-approval started. Keep in mind every lender is a little different and every situation is unique. So these items will be the bare minimum necessary just to get you going in the mortgage process. So 2 years of W-2s and your latest pay stub. And when it says 2 years of federal tax returns, it's important to know that we don't mean the 1-inch thick stack of paper that you filed every single year for the last couple of years. We just mean the top page surmising your taxes. During the process, your mortgage consultant is also going to go over the rough numbers for your closing costs and fees, explain down payment, how much you'll need, and the process and the different requirements. And they're also going to pull your credit for the first time, but most likely not the last time. It can be pulled up to 3 times during the mortgage process. And some lenders also require an upfront application fee. The fees can vary from a couple hundred to a couple $1,000, so just make sure that you have your checkbook ready in case the lender requires these upfront. If you're planning on going with Alliant, it's not an issue, but it is common with other lenders. All right, loan options. They affect so much. So we already kind of talked about the 20% down and PMI, and we didn't really talk too much about low down payment programs. Now, we all remember what happened in 2008, the mortgage crisis. It was awful. Because of that, our administration at the time had made a lot of changes through the federal government on what was really available. And to protect Americans, most low down payment programs were either eliminated or extremely difficult to get. You had to be in the military or in a certain area to even be applicable for them. We do have a new administration. I think most people know that. We're all pretty aware of that. So with every administration comes changes. Some of the changes that have been made since our new administration has taken office is that there are more programs. We're seeing a resurgence of the low down payment and even zero down payment programs becoming available. This can be amazing for certain people who really are able to afford a mortgage payment, and they just have difficulty saving up that down payment. So it can really help a lot of people get into a home who otherwise may not have been able to. Fixed rates. Now, we all hear about fixed rate and adjustable rate mortgages. I'm going to go into that in a little bit. Adjustable rate mortgages, in my humble opinion, have been given a really bad rap, especially ever since the mortgage crisis. I'm on an adjustable rate mortgage. I love it. But there are a lot of pros to going with a fixed rate mortgage too. So I'm going to go over that with you guys in a little bit. And if you have further questions on that, again, please don't hesitate to ping me, comment, raise your hand on the sidebar, and I will be more than happy to kind of go over some of those differences with you. And if you have other questions too, we have a million different people working in our mortgage department that can help answer any kind of private question that you might have. Home equity line of credit. This is a secondary mortgage product. We're not really going to go too much into this today, but some people actually get home equity lines of credit the minute they get their first mortgage. Some of our members do that. So it is a secondary mortgage product. It's open-ended use of funds, so you can use it for just about anything, which can really help if you have student loan debt or a car loan or credit card debt that you want to pay off, or maybe you're buying a house that's a fixer upper and you're going to need to put some sweat equity into it. So those funds are available for that. So let's move on and talk about this a little bit more in depth. Fixed or adjustable. This is the topic everyone seems to have an opinion on, including myself. So fixed rates are simplistic mortgages. They're straightforward, locked-in payment, no surprises, little to no risk, and they're easy to manage. So what's the downfall? A higher rate. Sometimes the rate on a fixed rate mortgage can be upwards of 200 basis points higher than the adjustable equivalent. If you have a larger loan, maybe over $300,000, it might be worth looking into an adjustable rate mortgage depending on your unique situation. Keep in mind, nationwide, the average first-time home buyer owns their home for an average of 11 years. And in the Sacramento Valley area, the average first-time home buyer owns their home, their first home, for about 7. So it's important to think about that when you're settling into a mortgage. No matter what terms you choose and what kind of home you're purchasing, you can never take your mortgage with you. But you can be picky on the type of loan that you want or you need. For myself, I have a 10-10-10. It's an adjustable mortgage. It's fixed at a rate for 10 years, adjusts one time, then it's fixed at that rate for another 10 years, and then it adjusts again, and then it's fixed at that rate for 10 years. Yes, the rate is a risk. It can adjust much higher, but I do know what the ceiling rate for that rate adjustment can be. When I signed the mortgage, I knew it up front. So it won't be a total surprise, and I can always refinance if I really hate the rate that it's adjusted to. But my favorite thing about my adjustable rate, personally, is saving money off the top end of the loan. I'd much rather pay 3% on my loan for 10 years, paying down that principal faster, than 5% over 30 years, paying more interest up front and the principal later down the line. I like to have control of my situation a little bit more. So in fact, in 10 years, I can probably even refinance to a fixed rate loan if I choose. And I can probably even shave off a few years off the loan, maybe choosing to get a 15-year fixed after this 10-year period instead of a 20-year fixed, as I might have paid down the principal even further. Be able to afford a shorter term on my loan. And, we all know the lesser the term, the less you have to pay in percentage points. So if you were to go with a 15 versus a 20, you can usually save a little bit more on the interest. And when you go to get pre-approved, it's important that you take the time to discuss this with your mortgage consultant. They're experts, they know everything, and they're going to help guide you on your unique situation, your money, your terms, your unique situation. Everybody's different. And while most folks won't stay in their homes for 30 years, maybe your situation's different. Maybe you're buying a very special home. Maybe it has some kind of sentimental value. It's grandma's house or something. And those are the things that you're going to want to discuss up front with your real estate consultant. Finding a realtor. When selecting someone to represent your interests, it's really important to consider your needs. We'll go into county and city specific data in a moment, but it's important to do your research, find a local realtor with local expertise. And this is going to help in the unique environment that you're bidding in, you're putting offers in on homes. The state requirements vary, but in all states, you need to take a minimum number of classes and pass a test in order to earn your license to represent someone. Now, what's the difference? Agent, realtor, broker, dual agency. A realtor is a real estate agent who is a member of the National Association of Realtors. It's very much like a union, which means that he or she must uphold the standards of the association, its code of ethics. So let's talk dual agency. Never heard this term before? You're about to hear it now. Have you ever been to an open house and the realtor who is selling the home offers to represent you as well in the sale? This type of relationship might work out for the better or for the worse depending on the situation. Realtors are paid a commission based on the sale of the home. It is in their best interest and in the best interest of the seller to sell the home for as much as possible. There are situations which have dual agency that can work in both parties' favor, and that's great, but most of the times it is high risk. If the realtor has a large portfolio of clients running concurrent sales, they may need to close on the sale quicker and advise their clients to simply just go with the strongest offer, the most likely to close quickest without any issues. If you've spoken with the realtor at length and you've discussed your situation, they might realize the true potential to close the sale quicker, faster, easier. But even in the event that your offer might be lower than others, maybe you have guaranteed funding, a large down payment, amazing credit, or you have an employer-sponsored assistance plan to help you get into the home. No matter what, having good communication is always a good thing, especially with your realtor. So just make sure to communicate with everyone around you so you can get the best offer in. And whether you're buying or selling a home, it's important to check references of your realtor. Nowadays, that doesn't just mean calling around to their previous clients on some list or piece of paper that they gave you. It means checking Yelp, checking Realtor.com, Google, Zip Realty, Zillow. There are plenty of online forums where realtors list out their references and allow others to rate their experiences. Ask your friends and family, maybe they have a great reference for you. Just make sure to do your homework, do your due diligence, and check out every realtor that you can possibly find online or within your neighborhood. Finding your home. All right, so now you've got your realtor, your agent, your broker, whoever you're working with, and it's time to sit down and talk about your preferences. This is when you can really get into the nitty-gritty of the details. You can specify, do you want to live in a city, a suburb? Do you want a single-family home? Do you want it to be detached, attached? Do you want a townhouse, a condo? Do you need to be in an established neighborhood, or do you want a new neighborhood where there might be more equity in the future? Do you need to be near commute or mass transit? Do you want to be far away from a freeway? How does that work for you? Every individual is different. Your needs are going to vary depending on your lifestyle and where you are in life. So make sure to talk about that. Express that with your realtor, your representative, who's representing your interests. All right, let's talk about homes. So, the average price of a home in California is $440,000. Luckily, you are here in the Sacramento Valley. Houses are going for an average of $375,000. Now, that's still a lot of money, but it's less than most other people in the state of California are paying. So you have an advantage. There's room for growth. There's room for a lot of return on investment, which is fantastic. You're getting it at a good time. The down payments can be a little bit more affordable than they can be in the rest of this great state. Home buying in the Sacramento Valley is no joke. Some of the dilemmas in our area surround down payment. The average 20% down payment on a home here in the Sacramento Valley is close to half of the average total cost of a home anywhere else in the nation. That's a real problem for most individuals. In fact, the vast majority of home buyers in Sacramento need to save up an approximate year's worth of salary just to have the money accumulated for a down payment. And this isn't factoring in closing costs, mortgage fees, appraisals fees, potential work needed on the property. If you're in the same situation, I want you to refer back to that 401k slide with Vanguard and review your savings options. You might be surprised at what you can afford. All right, everyone, now we're on to my favorite part. We're going to talk about numbers and the difference between counties and cities and what you're going to find in your area. So, the information I'm sharing with you all came courtesy of Zillow.com. If you haven't checked them out previously, I would highly encourage you to do so. Personally, I love this site. I use it often. It's great for local market research, pricing out the value of homes, and it's relatively accurate for Northern California area. Sacramento County homes are valued at about $333,000. And outside the metro, they're renting for only slightly less than the downtown area. The ROI on these homes last year was a staggering 9.7%. 9.7. That's an amazing return on investment for any home in any part of the country. Even houses in the Silicon Valley didn't increase at that rate. And in 2017, this year, Zillow is predicting a great value increase still at 5.2%. So if you can afford to buy a home, folks, now is the time. The ROI numbers are just incredible in this region. Last note here, homes in the Sacramento Valley area are selling for an average of about $30,000 over list price. That's about 10% over the list price, and Zillow's notating a warming trend for this year. So that means the houses are going to be receiving more than one offer, and it can get a little competitive. So be prepared for a little back and forth on placing offers in this county. El Dorado. The houses here are higher than in Sacramento County. They're pricing around $423,000 on average, and they rent for more too. So if you're looking for an investment property, El Dorado seems to be a little bit better of an investment than Sacramento County, just reviewing the numbers here. The ROI on these homes last year was still a fantastic rate, almost 6.5%. And this year, Zillow is predicting the rate increasing at 4.5%. So just an amazing value. Last note here, the homes in El Dorado sell for an average of $20,000 under list price. So that's about 5% under the list price. And Zillow's notating a cold trend for this year, meaning that houses are going to be sitting on the market for a little bit longer. And you'll likely get into a home here under the list price. And this is important because you may be able to expand your search, above and beyond the pre-approval amount, knowing that you can get into a home in El Dorado with a little bit less of an offer. But as always, this is your realtor's job. So it's important for you to rely on them to make your best possible offer and help you search, for a home within your price range. Placer County. Placer homes are valued much higher than Sacramento County also, at around $450,000. And they rent for more too. So again, if you're looking for an investment property, Placer seems to be the best investment, better than Sacramento County, just reviewing these average rental prices and the statistics that I've been able to find online. The ROI on these homes last year was also great, 7.5%. I mean, you can't deny that. That's amazing. And this year, Zillow is predicting them to be just shy of 5%. For the market trends, homes in Placer are selling right around their list price, so you can expect to pay the price you see. This is, again, important to notate because you're going to want to make sure you're looking at how much home you can afford, what you can get into, and knowing where to bid and how much to bid, and if your offer is going to get you that home. It's a balancing act, and it's one that your realtor is really going to help guide you through. Buying and selling your home is all about timing. Some helpful tips here, whether you're the buyer or the seller, that April listings sell for about $20,000 more than in January. When you're walking into a home, if it's summer, if it's springtime, the house is going to be bright, cleaner, better smelling. Generally speaking, people are happier during summer months. The overall impressions of homes are higher, and folks like to move during the summer, especially if they have kids. They may need to move schools or districts. But in contrast, in the winter, the overall hue of a home is darker. The sun isn't out as bright. The homes can have visible leaks, smells, maybe some mold or some mildew, and negative quirks of the home show more in winter than they do in summer. So the houses sit longer, they sell for less. So if you're a buyer, while it might be inconvenient to buy a home in the dead of winter, it might be more financially just a better move for you. Whereas if you're a seller, you might want to think about looking in the spring or summertime. All right, you've been pre-approved, you've found that realtor, you've toured some houses, you're ready to make an offer and get that amazing home. So now what? How do you actually get the home without overbidding, without having to lose out from a better offer made by someone else? You really want this house. So what do? Preparation and a good realtor is going to make all the difference. If you haven't heard me say it already, I personally think Zillow is a great resource. Before you visit a home or before you're thinking about making an offer, you need to know the value of the home. The true value within reason is a combination of sale prices of comparable homes within a half mile to maybe a 1 mile radius, and then the condition of the home that you're looking at. In order to get this data, you can research online, you could see the prices of homes that have just sold in the immediate area, and you could probably even see pictures to really estimate whether they were in similar condition to the house you're visiting or maybe less or more. This will help you estimate the listing price on the home and see whether it's correct, too high, too low, and you can even inquire about other offers on the home or if the realtor is only accepting offers on a certain date. Pricing the home low and accepting offers on a particular date is usually indicative of the seller or the realtor wanting a bidding war, where the price of the home is driven up by multiple offers in a very short period of time. Make sure to adjust your offer according to the advice of your realtor and based on your own research. And just be prepared. There might be other offers, counter offers, and you might need to increase your offered amount. But prioritize staying within your pre-approved amount. If you go above that pre-approved amount, you're going to need to come up with additional funds or proof of funds upon making that offer. So just make sure to consult with your realtor and your mortgage consultant. It's always a best practice if you need any kind of guidance. I wanted to make sure I went over briefly the tax situation when it comes to home ownership. When you buy a home, it's not like any other tangible good or service with a flat tax that you pay up front. Generally speaking, you're going to pay upfront taxes on the home that you purchased for that year, but you're also going to have to pay taxes on that same property every year for as long as you own it. These taxes are taxes that you pay are a tax write-off, so it's not a total loss of money, but how you come up with those funds and how you pay those taxes is really up to you. Some lenders are going to ask or require you to use an impound account or an escrow account. Those terms are used interchangeably. So, in case you hear either one, they mean the same thing. It's a savings account that stores payments of your insurance and your taxes in a fund so that come tax time, the bill is paid in full automatically by them, the lender. and not by you. You don't have to pay a bill that comes in the mail every year. Not all institutions require it or even want to do this service, and some people don't like to have higher payments. They would just rather pay the bills as they arrive themselves. But it's important to note that most impound accounts do not offer interest. So if you're like me and you owe between $7,000 and $10,000 a year in property tax, then you're also losing out on any interest that you could have accrued had you have placed it into a savings account instead of an escrow account. Generally speaking, most homeowner insurance policies are paid annually, and they can vary between $600 and upwards of $3,000 or so per year. Just as when you have car insurance, home insurance can really vary in price depending on the needs that you have for your home and what kind of property you have. Taxes are similar too because of the local ordinances. For example, this is my tax statement actually. I live in San Mateo. In addition to the state tax, we also have Measure A and Measure B. They help fund our local schools. I know in San Francisco City and County, there's similar measures for teacher support, actual school support, and community college support. In your area, in Sacramento Valley, this is not including your Mello-Roos. It's a special tax that occurs very often in Sacramento and in the surrounding areas. And every city and county is going to face their own unique tax situation. So if you're looking for more information, more resources, I would recommend researching the parcel number on your county tax recorder website, just to find out history and any tax information that maybe you might need to know about. So you've made your offer. It's been accepted. Congratulations. But now what? Now comes closing and escrow process. During this time, you're going to be getting an inspection, and you will need to pay for this. The inspections generally cost between $300 and $500, and you're going to need to pay for that right away. Typically speaking, you can request to be present during the inspection or speak with the inspector prior to the inspection. And this is important because the inspection is just a general inspection. If you felt that the floors were maybe a little wonky, or you noticed that one of the light switches didn't work, or something was leaking, or really anything, this is your chance to bring that up. The inspector is going to look for those things, those items, and if needed, they're going to suggest a subject matter expert to investigate further. So wonky floor, he's going to ask for a foundation repair specialist to come out and take a look and give you a quote on what it is that's wrong and how much it is to fix it. Maybe it's going to be an electrician or a plumber. Those folks can give you actual numbers behind the damages of the property, and don't be alarmed. Most houses are going to have some kind of repair that needs to happen, and depending on the issue, the lender is going to may require some of those things to be fixed prior to funding the loan. These items are called contingencies. You're going to hear that as well. You might notice that upon looking at a home during the open house, there's a note on the pamphlet or the flyer that specifically calls out to no contingencies. This doesn't mean that the house is free from problems. It just means that if there is problems, that you're the one who's going to have to take care of it, not the seller. Now, let's say that there is problems. Let's say, for example, termites. It's a pretty common issue, especially in California. And the abatement is about $6,000 to have it fumigated and remediated. You have 3 days once the inspection is completed to get back to the seller and say, okay, I placed a bid on this home based off the value without termites. So now that we know it needs to be fixed, what would you like to do? The seller might be willing to fix it, give you a credit to fix it upon closing the sale of the house, or they might even just say, sorry, this is your problem now. And you have to actually pull money, and you have time to actually pull out from the offer if that's the case, or you may have to fix it yourself. If you decide to pull out from the offer, you won't get your inspection fee back, but you might be able to make an offer on another home that better suits your family or your unique situation, so the loss is really minimal. The most important thing to understand is that if there is a no contingencies clause in your offer, if that's the case, then whatever the issues are, you need to fix them. So the contingencies have been met, the inspection, the appraisal, all that's been completed, and now comes time to sign and get the loan funded. If you go with most other lenders, this means a writer's cramp and signing your name and your initials close to 100 times in what looks like a Yellow Pages thick packet of papers. If you go through Alliant like I did, you'll be happy to see that we use DocuSign, and you could save your hand and a tree from dying a little. I signed my docs on my cell phone, and personally, I loved the entire process. So anyhow, so you've signed the docs. Now it's time to fund the loan. Wherever your funds are waiting for the down payment and all the closing costs and fees, those funds are going to be exasperated, either from your savings that you have at that specific lending institution or being wired into the lending institution. It's at this time that you'll have the choice, hopefully, to set up a impound or escrow account for your taxes and your insurance, like we talked about on the last slide. Again, like I mentioned before, this isn't always mandatory, but other instances it is. So every lender has their own guidelines, so be sure to ask if they haven't gone over it with you already. You'll also need to grab insurance on your home. It could be just general insurance, or if you're in certain areas of the valley, you might be required to also get flood insurance. My advice to you is to get a quote from the company that helps you already with your auto insurance. A lot of times companies will give you a combined discount for bundling home and auto insurance, and you're going to want to save money really anywhere you can. All right, your loan is funded now, and it's time for you to get the keys to your new home. There is a clause, it's called rent back, that sometimes happens, and it can prevent you from moving into your home right away. So be sure to find out if that's the case. Rent back is when the seller is still living within the home for a short period of time, presumably while they wait for their loan to close and they can move into their new home. Once everything is done and over with and you do have the keys in your hand, this is when you can buy appliances and furniture and everything else that you need to decorate your lovely new home. But please, please, please wait until you have those keys. Your credit and your assets, those are important. You don't want to mess up the process. My last thought and bit of advice here: realtors often thank you for your business, and they'll offer you something. They'll offer to give you something like a Home Depot gift card or something along those lines. If they offer, I always say that you should ask the realtor to get a cleaning crew in there to clean the house, or a gardening team to mow the lawn. The reason why? No matter what, even brand new homes are filthy upon moving day. The last thing you want to do is scrub down your house with a bottle of Clorox or mow the lawn when you get there, and instead of when you should be unpacking. Make it easy on yourself. Get someone else to do that hard work, at least up front, so that your moving day is less stressful and it's just one less item to worry about. All right, I hope you have enjoyed the discussion today. If you find yourself having questions, wanting more, please reach out. Myself, Ed Cody, we are your Kaiser corporate contacts at Alliant, and we're ready to help with any general questions that you might have. And then Cam and Mark here below are your mortgage folks. They live and breathe all things housing. They are your Northern California associates here, and they'll be happy to answer any questions you have, a wide array of questions, anything you need. Thanks again for joining us, and I really look forward to hearing back from all of you soon. Take care.